do not miss that train. Today I'm going to speak about dividend stocks. Everybody's talking about growth stocks, all these high yielding companies in the last March, April, May, June, all that growth after COVID-19, but people are forgetting about the great value dividends. Great value just now and nobody's buying them. So let me explain to you these three markets, the UK, US and European markets, in this three-part series of this video on why you shouldn't miss this and what dividend stocks you should be focusing on. So I've done the homework and I'm sharing that with you. Welcome back to part 2 of this video, which I'm going to be speaking about the great American companies, dividend American companies that are great to invest, great value. People are just missing this train. So don't miss this train. Middle of July towards the end of 2020, and when the economy recovers, when everything's back to normal, their stocks will not be as cheap like this for another good 5 to 6 years. Dividend stocks shouldn't be missed. Dividend stocks do not create as much excitement as growth stocks. They're not exciting where you can see 10%, 20% growth, 30% growth per year, but they do pay a good chunk of 2, 3, 4, 5%, which helps you compound and grow your portfolio. And these are the easiest company to invest. Where you've got money, you're just going to invest more. When debt, you're going to invest more. So your holdings in these companies will grow bigger and bigger and bigger, like Mr. Warren Buffett and many other great investors around the world. All these rich people put their money in dividend stocks. They get income from these dividend stocks. That's how the rich gets richer. I'm sharing that with you today. Company number 1. I like this. I miss the morning breakfast. It's McDonald's. Guys, it's McDonald's. Okay. During the lockdown, McDonald's is still serving, they're still delivering. Lots of restaurants will be closing. Okay. There was a great writer, New York Times writer, did say that after COVID-19, a lot of restaurants will go bankrupt. And the only one that will be left standing will be McDonald's. It's true. The McDonald's all over the world, they're still innovating the way they serve food. They're innovating their menu. They're innovating their shop with self-service, deliveries. They're still growing. They're always thinking cash flows move. So McDonald's, 2.72%, with a healthy PE ratio. McDonald's is one of those companies that will not go down. With COVID-19, they're still standing tall. Yes, they're not selling as much burgers as they were last year, but when they open up, they'll just revert back to normal and they'll give people jobs back and things will get recycling and get on again. So invest in the great companies. If COVID-19 can't take them down, you have to invest in them. So McDonald's, 2.72%, healthy P ratio, at a price that hovers between 180. I've bought them at 180 points. If they do go 160, then buy them again. I missed them at 132. What an idiot. Anyway, so McDonald's is my number 1 in the list. Okay, and number two on the list, Johnson & Johnson. Johnson too. So Johnson & Johnson will be involved with the COVID-19 vaccine production line. They'll be involved in any form of vaccine. They'll still be involved in the household goods and everything. So Johnson & Johnson, they did drop, but have recovered their stocks now. 2.87%. Great company to own, healthy P ratio. Johnson & Johnson used to be a AAA stock, but obviously they're fallen quite a bit. But hey, everybody still use Johnson & Johnson products. It's everywhere. You know, so if the company's growing a bit bigger than they used to be 10 years ago, but it's still a company that you should, no doubt they should own. If COVID-19 can take them down, in fact, they'll be playing a part to help COVID-19. So Johnson & Johnson, 2.87%. It's still a good value just now. They grow. Don't expect them to grow like Google or Tesla or Apple, but they're there to pay you great dividends. They're there to pay you around about almost 3% dividends. Are you going to complain? Are you going to get that from your interest rates? No. So Johnson & Johnson number 2. Still looking for a broker? Don't wait. Join Hargreaves Langston. I use it for my family, my pension, the kids' investment, all in one basket. It's a really good company, great security, amazing products. You'll not regret it. So join Hargreaves Langston today. So at number three, it's one of the higher pay in the list, 6.19%. AT&T, symbol T for the ticker. AT&T just released the HBO Max. You know, it's a really big conglomerate. It's a huge company that goes into 4G. They're going into the 5G generation next. And AT&T have got their media part of the business. There's some people call AT&T slow and sluggish, but AT&T pay growing dividends, 6.91%. Yeah, even if they cut their dividends to 4%, why not? They're still paying a good dividend. One of the best dividend payer in the UK, in the US. I, as a UK investor, I buy them on my UK broker. So AT&T, I don't see why I need to go into deeper on why we shouldn't buy AT&T. If you love your dividend in the US, you're looking to boost your dividend yield a bit more, you should own AT&T. Alright, now down to the fourth one. I go to that shop every single week, sometimes twice a week. I buy everything in that shop, from pillows to duvets to slippers to chicken to sea bass to salmon. Costco. Yes, Costco. Yes, Costco. Yes, Costco. Everything in this room is almost Costco. It's either IKEA or Costco. So if you buy everything from Costco, COVID-19 is not going to take this company down. They'll be serving everybody still through a harsh environment, happy, healthy environment. Why not? Costco is the one for you. At 3.16%, the shares were rocketing up during COVID-19, but they're back down to 300 again. And healthy PE ratio, the shop is always full. You know, Costco is not going to be shy on selling great products, great services, membership fees. Costco, you can change your tire. I cannot stop talking about Costco. If you got spare cash, if you need some dividend, Costco is the one for you. I don't have to explain how great Costco is. If you like all the amazing thumbnails and all the graphics that I create for my YouTube video, it's all done by Canva. So if you click on the link below and join Canva, if you're a one-man band or if you've got a project or you got a small business, Canva is a really amazing tool. I've used it for the last 3 years and it's really boosted my journey. So click on the link below and join the Canva family now. Number five. Morgan Stanley or Goldman Sachs. This company pays about 3% dividend. I know banks, high street banks, retail banks are slashing the dividends in the UK, in Europe, in America they're still resisting, but these are investment companies. Goldman Sachs, Morgan Stanley. I hope that you guys got it when the COVID-19 dipped, when they were so really cheap. Even if you have missed that train, it's still paying you 3%. So if you're looking to spread, not just in pharmaceutical, not just in retail, Costco, not just in McDonald's food, you want to go a bit more financial sector, pays great money, that will grow when our economy recovers. Morgan Stanley, Goldman Sachs is great at 3%. I never spoke about oil company in the UK version, but in the US version, there's one company that still does well. Chevron. CFX. What's the ticker again? Ticker here. Chevron. Great. Chevron, to me, in the world now, there's only two great oil companies, Chevron and Total. If you're in America, Chevron. Chevron pays a healthy about 5% dividend. They're the only ones that's great at cost control, that the great companies that's churning out, even in the oil crisis climate, they're still doing well. Healthy oil fields. Chevron is where you should be putting. If you want to, some people are a bit skeptical of going into oil. If you're one of those CNBC viewers, my God, oil is not the place to be. But you know, Chevron's healthy. We still need oil. Going down the electric vehicle route, you know, electric solar power panel, we still need oil. End of the day, to get things going until we reach a more green environmental route. So Chevron, it's there on the list. Don't miss it. The very last one on the list, Proctor Gamble, 2.62%. Steady company, regardless of whatever happens. You know, Procter & Gamble is still in the game, similar to the likes of Unilever in the UK. You know, people are hoarding, people are buying. Procter & Gamble will make profits, but maybe a bit not as much as pharmaceutical companies because they're a bit more diverse. We have restaurants, we have shops, we have offices closing. So some sectors on the cleaning products and some restaurant type business products, they might not be doing well because they're not selling the volume they are. But Procter & Gamble, still good cash flow, less cash buyback, but still they're trying to keep things going, keep moving. And Procter & Gamble, they might have gone up, they might recover as much since already, but something to consider. So this is the end of my 7+1 US company dividends that you should invest in. These are the ones that, you know, more reliable that you can try. If you got a US portfolio, try to get it boosted up to 3 to 4% dividends if on your diversified portfolio. And you know, it's not just about the growth stocks. It's not just about the great growth company, but it's one of those more staple ones that you have to keep. And if you got money in your savings that's earning no interest, dividend might be the way to go for you. But then again, I need to warn you that capital is still at risk if you're investing your stocks in stocks and shares. So I hope you enjoy this part 2 of 3 of this video. My next part series will be European Union stocks that I'm going to share with you. But please do like and subscribe on my Facebook, my YouTube, and if you are a big fan, you can subscribe me on Patreon. And join me on my journey on dividend investing. Do not miss this train. Once they leave, they leave. And so I'll see you in the next part of the video, and I hope you've enjoyed your time today. See you soon. There.